I'd like to go ahead and call this work session of the Anchorage Assembly to order. Begin by going around the table and identifying ourselves. Mr. Hall.
Assembly Member Ernie Hall.
Phil Starr, Assembly.
Jennifer Johnson, Assembly.
Dick Trainee, Assembly.
Jennifer Johnson.
Patrick Flynn, Assembly.
Lucinda Mahoney, CFO.
Board Director Bill Shepherd.
Ed Leon, report.
Very good. Are you our lead person on this?
I am.
Would you like to go for it?
Okay.
And do you want questions at the end or first?
Interspersed.
Okay.
So the discussion is what a workshop is. So, yeah. So the objective of the presentation today is to provide you with a review of the analysis that we do pretty regularly in regard to the port's debt capacity. And in this review, what we do is we look at what are the historical financial trends of the port and what do we see going forward. And the combination of all of this data is then what we use to calculate what we think is a sustainable debt service level for the port. So that's the overall objective for our meeting today. But before we get into that, I thought first what we would do is provide just a high-level review of the funding and the financing plan for the port and the entire expansion project, and identify where the source of funds are, what's been spent to date, and then what's anticipated to be spent in the future. So I have a chart that will go through that. Then secondly, what I'll do is provide some background information just about the difference between commercial paper as a financing tool versus using a revenue bond, and share with you why we've chosen to use commercial paper for this phase of the project. Then we'll go specifically into the debt capacity calculation, how we got there, what exactly it is. And then lastly, I'll wrap up with the detailed financials in regard to operating revenues, operating expenses, both historically and into the future. So with that, we'll go ahead and start with the financing plan. And I'm sure you've seen all of this information before from Governor Sheffield and the people at the port. But what I wanted to do is just put it all together in a nice little box so that we could ensure that everybody understands what we're talking about today and how it fits into the overall picture. What this plan does is assumes a $1.2 billion project with the completion date of phase 1 being targeted as 2019. And so what I've done is documented how much funding we've received to date on the project and the source of the funding, and then what we anticipate to receive in the future, as well as its associated sourcing. So for example, we've received already and have put to work $372 million. 139 of it came from federal funds, 121 state funds, 72 million of it came from port equity, 40 million of it is commercial paper. And the commercial paper and the 40 million is really the focus of our conversation today. So I wanted to let you know how the 40 million fit into the overall financing picture. We anticipate 300 million of federal funds in the future, 508 million of state funds, of which 322 million will be requested in the legislative session this next year. We anticipate an additional 64 million in equity from the port, for a total of 872 million in still anticipated funding. Bottom line, this adds up to the 1.2 billion. Jennifer. I just wanted to ask, this is based on right now the plan going forward and as far as construction, but that's still sort of being worked on. So
Exactly.
these figures are not ones that are in stone.
That's exactly right, and that's a really good point, because the fiscal plan that we are going to talk about today is 3 to 4 years out. As you can see, just phase 1 here is out to 2019, and if there are additional phases, it goes out even further. But in regard to looking at the operating revenues and the operating expenses that can be generated to pay debt service, we are looking at a very small piece of this entire project. and I'll get to that. But I wanted you to see the big picture first so that you could see where we are, so that we can hone in then on the 40 million.
How much annual state funding are you assuming here
Well,
per year?
Governor, would you like to?
I missed the question.
How much money are you expecting from the state every year for the next 7 years?
I'm expecting to get, in 2012, $322 million, which is over a period of 6 years, 5 to 6 years. Those dollars would be spent to complete the entire north end of the port. That means we move tote, ocean trailer, we move horizon lines to their new temporary areas.
So about 55 million a year.
Yeah, naturally, we can't spend $322 million in 1 year. So it comes out to be that. It could be, some contracts might be 70 million, some might be 50 million, but that's not totally determined yet. But it would complete the entire north end of the port, moving tote, moving horizon lines to their new temporary areas. So-
I'm sorry, Mr. Governor. There's a couple of people who wanted to ask you a question, but do you want to finish?
Yes, well, the only thing I wanted to add was that $322 million would be, we anticipate a port bond bill next year and the legislature.
Thank you. Ms. Gray Jackson and then Mr. McHale.
Thank you, Madam Chair. So then, in 2012, the administration is going to ask for a state appropriation of $322 million.
Yes.
Thank you. Thank you,
Mr.
Madam Chair.
McHale.
That was the point I was going to make. And then the other thing is that even though we'll get the appropriation, we'd only use what we needed for each year, obviously, so that we don't accumulate interest payments, et cetera, unnecessarily. So it would be based on whatever we needed for cash flow.
Thank you.
Okay, so that's the overall financing plan. So now let's hone in on the component of the financing plan that relates to the debt that is on the municipality's balance sheet. So, as I mentioned earlier, we've elected to use commercial paper as the credit facility to provide this $40 million. So first of all, and I apologize for those of you who already know and understand commercial paper, but I just thought I would provide an overview for those of you who are new to it. But essentially what it is, it's a short-term loan. It's similar to a short-term loan. It has a fixed maturity anywhere from 1 to 270 days. It is currently secured with the port revenues, and it's very similar to a line of credit, but it's different in that it's actually a security that we put out into the market that investors invest in. And so, for example, institutional investors may need a place to put their cash on a short-term basis to earn interest. So those would be the types of folks that would purchase our commercial paper. We currently use U.S. Bank to be our credit facility provider, and we do have established a $75 million credit availability with them. We've used $40 million of that, and of course the reason we're here today is to discuss, is $40 million an appropriate amount, or could we go higher with this particular line of credit? Currently, we are paying 0.33% for 5 months of having access to this money. And this is a screaming deal. This is really a very low interest rate, and it's a reflection of what's going on in the market. I mean, right now, short-term interest rates are extremely low. So this is an area where we are able to take advantage of that. The rating that we have at the port is A-1 plus with S&P, and the way Fitch rates it, it's F1 plus. These ratings will likely be updated soon. We'll probably have to go through a rating analysis with each of these organizations because our rating is about 5 years old. Anyways, for those of you who have been on the assembly, this background information below is probably, old news, but this was all authorized in an ordinance back in 2008 in terms of allowing us to use this type of credit facility. Any questions? Mr. Flynn?
Lucinda, do you have a feel for what would happen to the commercial paper market if Congress doesn't get their act together here in the next couple of weeks?
Well, I'm concerned about that for more than just commercial paper.
Well, sure, but specific
Yeah,
to this one.
absolutely. If interest rates go up, when we reissue this commercial paper here in the month of August, it is possible that those interest rates could go up as well, which would mean our cost of interest would go up.
Sure.
But when we compare that to issuing revenue bonds, which I'll show you later on, it's still much more cost effective to use commercial paper because it's on the shorter end of the yield curve. And so you get a lower interest rate.
Ms. Johnson?
I just, to follow up on that, and you've looked historically what happened to us in 2008 when we were trying to roll over our commercial paper, right?
Ross has reminded me, yes, he has totally reminded me. And that is the reason why, when we look at the debt capacity, we are very conservative in that, because we want to make absolutely sure that we have the cash flows at the port to cover the interest expense and any debt payments.
And would you like to remind?
Please remind us.
What happened?
Yes.
Ross was here, and I'll have him explain it.
What was it?
What happened in 2008, with the lack of liquidity?
Well, in lack of liquidity, in the short-term market was based upon credit providers that lost their rating. Okay? In fact, Dexia was one of those credit raters, a European bank that was damaged, their credit rating was damaged. And so we paid a higher rate of interest for them being in first position to mature the paper. So the credit provider in the credit facility, when we recently switched to U.S. Bank, the credit facility is the first person that pays when the paper matures, and then we reimburse the credit facility provider with a new issue of commercial paper. So it's called a roll. We roll it. And Dexia wanted out of the market altogether for all of their customers, so they left the market, and we replaced them with U.S. Bank, a better rated quality credit. So if something does happen in August, and the credit markets go into sort of disarray, what the investors really look at is the credit of U.S. Bank, because we're paying for them to be the first in line. And so their credit is stable. We don't expect anything to happen to them. So the investor will continue to rely on U.S. Bank to pay at maturity, and then U.S. Bank worries about getting repaid when we roll the commercial paper. So we're comfortable that we're comfortable with the credit facility that we have going into August.
So moving on to the question of why we've selected commercial paper instead of revenue bonds. As I alluded to earlier, revenue bonds are more expensive. And for example, if we would issue revenue bonds for the port, if you make the assumptions of a Standard & Poor's rating of A, 30U revenue bonds, and a current interest rate today of 5.9%, just the interest cost alone would be $2.4 million a year. And when you compare that to the way we're managing it currently with commercial paper, our annual cost is $878,000. So we're saving just under $1.5 million a year by using commercial paper as our funding source and our short-term debt for this particular project. So it's a really good decision for us to do this.
That's great, Jack.
Thank you, Madam Chair. Lucinda, I'm looking at the paper, and it says annual interest cost for $40,132,000. So the 800 and whatever number you said just now for annual interest cost, that relates to what number?
If you look at the $878,000,
What page are we on?
right here, and why don't we issue revenue bonds?
Okay.
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 It's comprised of the interest fee as well as the fees that we pay to US Bank to manage the program.
Okay.
And that's $746,000. It's about 95 basis points on
Right.
45, on
All right,
40 million.
thank you. Thank you, Madam Chair. I was still on the commercial
Oh,
paper
okay, I
page.
jumped.
I looked at this real closely. Thank you, Madam Chair.
Thank you. Ms. Drummond has joined us.
Okay. All right, so anyways, so this is just an indication that this is a really good way for us to manage this short-term debt. So the next question is how do we really determine if the 40 million is an appropriate amount? And what we have to do is look at a situation, I guess, similar to what happened in 2008 and 2009 and anticipate the worst and figure out what would our situation be should we not be able to roll the commercial paper. And so in that situation, if we couldn't roll it, what we would have to do is we would have to issue revenue bonds. And so then the question is what would the debt service be associated with the revenue bonds in a sustainable environment such that we could support it with the port's cash flow? So we have to go through, all of this analysis as though we were an investor of revenue bonds. And what we look at is the ongoing revenues, the expenses, the cash flow, and then what is the debt coverage ratio that would be needed with this debt service. And so we look at all of these assumptions, and we've actually built a 30-page financial model that goes through and does a lot of this analysis, and through using a present value formula, it backs into what the debt service should be. And we've been working with our consultant for Southwest to ensure that the model is accurate, we've got all the right assumptions in it. And so that's how we come up with a $51 million number. So right now we're at 40 million, and if we needed to, we could go as high as 51 million based on the data that we have today and based on where we see the port financials going in the future.
Lucinda, and maybe it can't be answered here at the table, but if one of the major customers, one of the steamship companies, diverted to a different port, how would that affect the debt capacity?
Well, it would negatively affect it
I
because.
understand, but about
Right.
how far?
Well, it would depend on what the loss of revenues would be. Now, if you go to the next page, you'll be able to see that depending on who that customer is and what the revenue impact would be. And I'm going to answer your question in a kind of a long answer by going through this model, but if I don't come back to it directly, remind me because I will.
Okay.
But to answer it immediately, what we've done is we've selected a cash flow that is conservative. And by being conservative, we are anticipating that we may not get some of our revenues. And by doing that, then we would enable us to have the coverage that we need for the debt service if we had to go to a revenue bond. So what this page represents is the historical picture of what our operating revenues have been, our operating expenses, our operating income, and then when you look at cash flow, which is what you need to cover your debt service, what we do is we add back in the depreciation. And that is the number that investors in our commercial paper would look at, as well as rating agents and folks who would buy revenue bonds. They want to be able to understand, do you have the cash flow to cover the debt? So as you look at this, you can see beginning in 2007, we were at 4.9 million, 4.8. You can see what 3.9 in 2009, that was a result of the recession. The port bounced back in 2010. And then now looking to the future, the original forecast for this year was 6.1 million and pretty consistent for 12 and then bumping up to 7 million in 2013 and 2014. But based on 2010, or actually we used the 2010 cash flow number as the basis for calculating the debt capacity. We didn't use the larger numbers going into the future because we're taking a conservative approach just in case 2009 would happen again. The other thing too is there's just more upside. If the port can get up to the $6 million cash flow number, you know, I feel like if they can get up to that level and they can perform at that level for a while, then I would be willing to make a recommendation to increase the debt for commercial paper, but not until then.
Mr. Birch?
I just had a quick question. Is the depreciation, are you backing that out? Is it part of your operating expenses?
It is not.
I'm trying.
Oh, wait, it is, actually it is. So you
Yeah.
add, you
So you're
calculate
just
your
back-
operating in and then you add it
Yeah,
back in.
yeah, so, yeah, okay, I understand. Okay, so the depreciation is actually embedded in your operating expenses, so you're backing it out, so you have a real,
To add it back in. Mhm.
add it back in, so you have a real cash flow number. Okay,
Mhm.
thanks.
Mhm. Okay, any questions on that? All right.
Just one quick one. So primarily we're looking at this figure, or is it?
The 4.9, yeah. And that's what, you know, when we look at what happened historically, and take, you know, out 2009, and then look at where we were going in the future with the cash flows, we just felt most comfortable with 4.9.
Good. I'd follow
Ms.
up.
Birch?
Just to follow up on the depreciation, depreciation is typically a way of that you setting aside a future account for replacement, right?
Well,
Ultimately.
when you take your assets and you place them in service, then you estimate a useful life, and then you take that as a deduction on your income statement, essentially as a manner to indicate that you've recovered your capital investment.
So a $1 billion asset, what would the depreciation be?
Well, it would depend on the life of the asset, but if it's 30 years, it'd be $1 billion divided by 30 million.
Big
Or
number.
30, yeah.
Yeah.
At this point in time, though, when I looked at the balance sheet, I recall that our total assets placed in service was about 135 million. Is that right?
Okay.
So that depreciation is
Right.
reflective of that.
100, okay.
Yeah. One thing to,
Well, I was just gonna follow up, and any depreciation for further construction will not be started until its completion, right?
Right.
And then we discuss the issue of depreciation.
right,
on
and
a-
so
on
if you
a
look really
billion-dollar-
long-term here, and think about a $1.2 billion investment. When we place that in service and we start depreciating it, this depreciation number is going to skyrocket, and your net income is gonna plummet. The financials of this are gonna turn upside down, unless we have revenues to offset this huge depreciation. And so at that point, it really becomes very similar to the financial specific venture in Denina, which is our goal is to operate it on a positive cash flow basis, recognizing that this is really good for our community. I mean, and the port is really good for the state, you know. And so it becomes a real cash flow management game rather than just straight net income.
Thank you.
Mr. Schwinn?
It's probably the question best for Ed, so a little follow-up on what I asked you before. We don't break these out by customer, and we shouldn't, because that's proprietary information. The revenue associated with each customer, we don't say, this customer gives us this many dollars, and this one gives us that many, because that wouldn't be appropriate. But in sort of doing a rough estimate based on my cursory knowledge of port operations, I think if you removed one of the steamship customers from Port of Anchorage, for whatever reason, we'd be operating at a net loss. Is that correct?
Well, if you would lose that revenue, you know, the largest revenue we have is off the container ships.
Right.
You know, we're busy on both ends with the fuel on one end and the containers on another, but let me say it this way, these shippers all make a good profit on running Anchorage. They all go to Guam, and they all go to Hawaii, a place like that, but this is the bread and butter run for them. And there's not any of them gonna be going anywhere else. If somebody went someplace else, somebody would come right in behind it.
Was that a yes or a no? I'm sorry.
Patrick, it would impact the debt capacity,
I'm aware.
of course, but the question is how much? And because we've chosen a conservative number, I feel like it would have to be a really significant revenue loss in order for us to reduce the commercial paper program.
Mr. Starr?
Patrick's plan is sort of the worst case what if scenarios. So if we had a commercial paper issue or problem issuing and refunding that, and then we had also an issue where we couldn't bond effectively or rates there, we would be interested perhaps in tapping into our municipal cash pool. If we sold assets, we have 500-some million in municipal cash pool. If we needed to cover a $40 million debt or even a $50 million debt out of municipal cash pool, what would happen to our bond rating and our ability to do that? Would you be uncomfortable with that decision to just take pure cash from the municipality and cover our debts?
Of course, I would be uncomfortable with that.
Well, it's a 10% down, it would be about a 10% pull down of our cash resources to do it, but the city's not gonna be insolvent because of that.
I think Ross has
If I may, Mr. Flynn, Mr. Starr, the credit facility provider I spoke of earlier, US Bank, now they are the first in line to pay a maturity on a commercial paper. If we're unable to issue more commercial paper on the same day and reimburse US Bank for their payment of the maturity, then if for some reason we were unable to do that and didn't provide the funds to US Bank through a commercial paper roll or other means that we may have available to us, then they automatically become a lender to us for the $40 million. And at a prearranged interest rate, and then at that point, then we would regroup and see where we are with regard to how we would go forward with that $40 million liability.
Well, my question is just the bigger picture of the fiscal health of the community. As you take on additional risk for your sub-managed units, you have to look at the big picture on how that fits in there. Of course, the school district has sort of that same relationship with the debt financed out there. We ultimately fall to that. So I only ask that question because we have that ability to short bridge if we needed to. All right.
And in the past, we have borrowed
I
from
know.
LNP, you know,
Yeah.
they are sitting on a lot of cash. I mean, that's always an option. Of course, there are concerns with the RCA, you know, when we do that. But in an emergency situation, I think we'd come up with something.
Yeah, well, you have the bonds versus the short-term commercial paper issuance, and I just throw in the mix of the third one as we have the cash. So, okay,
Yep.
thank you.
Yep.
Mr. Roman?
Thank you. I want to go back to Governor Sheffield's reference to who would move in after if somebody pulled out. I don't think I've said this to this group before, but last year on a road trip to Haines through Alaska and Canada, I observed a lot of trucks from Sam's Club and Walmart heading south through Canada. And I asked Mr. Rebuffo when I saw him next time, I said, are those coming through the Port of Anchorage? He said, yep. So and it's because apparently they get to their Midwest markets 2 weeks earlier than coming through Los Angeles or any of the other West Coast ports. I'd love to hear the governor elaborate on that potential, because it sounds like what he said. If somebody removes themselves from our market, there is traffic that will come through Anchorage because of our size and speed of customs clearance and that sort of thing. Yeah, I'd love to hear about it.
Did you hear the question?
Well, yes, I think so. There's less trucks on the highway now than there were several years ago. But that remains. There's probably enough trucks on the highway to make up a container ship every couple of months. And everybody in the freight business knows what everybody else is doing. We're probably the last to be able to figure it out, but it's there's been another shipping company in Alaska, as they were 15 years ago, looking around at maybe coming up here, and they're doing their due diligence and looking at their options, and they, it was all kind of prompted when Horizon Lines had a financial problem, which they still have a financial problem, but they're redoing their bond indebtedness and so on and so forth, and that'll probably work, and they'll stay here. But there is another company that wants to come in, and they're looking at maybe being the third container ship company, or maybe buy out Horizon Lines and to be the second, and to take them over. This is a good market because we're a meat and potato port. We bring in everything that everybody uses that lives here for 85% of the state. So unless everybody left, tomorrow we'll always have a pretty good business, and we grow to a certain extent all the time. So the fact that you referred to, Mr. Flynn, one left. I don't think anybody's leaving. In fact, I'm sure of that. But if they did, somebody would hop right in behind them and be coming in here in a New York minute. So I think that if you had the third carrier, you would probably take more business off the barge lines, and you'd probably take more trucks off the highway. If you had that's what I hear from the industry.
Thanks.
Another question.
You're the presenter, you have a
Well,
question, go
through
ahead.
the chair. Patrick, I thought of another response to your question about if we had a reduction in revenues, how it would impact the debt capacity. And what we did was we did model 3 different cash flows. One was the 4.9, and then another was 4.7 million, and then another was 6 million. So as I look at the model for the 4.7 million, which would represent a $200,000 reduction in revenues, the difference in the debt capacity is 2 million. So it goes from 51 million down to 49. So not sure if you can do it $100,000 per every million, but I think that
It's a rough ratio.
is a pretty good ratio, yeah.
Okay, thank you very much, that helps.
Proceed.
That's really all I have in terms of where we're going.
I have one question. We have heard a lot of discussion about the annual upkeep needs of the dock, the piers, the corrosion, et cetera. Is depreciation kind of figured specifically for an entity, or is it a standard formula? I guess my thinking is maybe there'd be more depreciation because our upkeep costs on the port are so high.
Yeah, it would depend on whether it's booked as maintenance and an expense versus a capital project, which would then be placed in service and depreciated.
Do we know which way it is?
Can you address specifically how that, you're talking about the piling repairs?
Well, as each asset is put on the books, it's given a length, an economic term on it. The dock piling repairs themselves are being put on it for 30 years. Originally, when the dock pile was put in 1960, if you will, it was put in for 30 years. Of course, now we've passed that time. So that's why we're in the bind we are today. As we add repairs, as we add assets to the plant, the value of the port, then that gets amortized over a new period of time. And perhaps the old one that is replaced has already been written off, if you will, salvaged out.
So when we repair a piling, it becomes a 30-year asset?
The repair itself does, yes. For example, every year we put $1.5 million into the port in dock pile repair.
Right.
That gets depreciated out, and $1.5 million does.
Oh, I see.
Just a dollar
I got
amount
it.
that we had increased the asset line.
Any other questions? Thank you very much. we're done.